Welcome back to the Behind the Well Show. This is your host, Roger Abel, here with Elias. Eli, how's it going this week?
Good. How are you?
Good. Question. What age do people in China retire?
I have no idea.
I didn't either. Men, this is from Bloomberg. I thought this was interesting, but so in China, there's a forced retirement age, and the last time they increased the retirement age was 1978.
Okay, what is the age?
I want you to guess. Since you don't know, I want you to guess.
And it's age you have to retire?
Yeah, well, the way this states, this is when you will retire.
Age 60?
Men will retire at age 63 now instead of 60. So you're close. Women will retire at 55 instead of 50. And in management positions, 58 instead of 55. So up until this year in China, women retired at 50.
It's not a bad rule, I don't think.
I mean,
but it's probably, they're probably forced to. It's probably not a choice, right?
Yeah, it's not a choice.
But when it says retired, do they have, what do they have? Like, do they have pension there?
I'm sure
do they do Social Security?
It's a socialist regime. I'm sure it's all funded by the government at some level. I don't know how good or bad that is. I just thought it was really odd that in America, we get to choose our retirement date. And in China, they tell you when you'll retire. Like, and I don't know, are you able to, like, maybe if you're a business owner, you don't have to. I just don't know how all that works. But I just thought it was an interesting article. I ran by, I forwarded it to Molly here not too long ago. But I think part of the reason they're delaying is just, they probably need workers for longer. And I was shocked by it. I had no idea that they forced a retirement age upon people.
Yeah, I only know of that in certain industries here. I know there's some industries you can only work until a certain age.
In other news, I just got this posted, just literally came across as we're doing this. CNBC, Amazon tells employees to return to the office 5 days a week. What I say 2 years ago, everybody's coming back to the office.
Yeah, remote work's just not as effective.
People don't want to listen to the dog in the background and, crying baby, and nothing against dogs or babies. But when you call a customer service number, you want to talk to a person who's paying attention. And we talked about this 2 years ago. We said, what's going to happen? These companies are going to get their quarterly reports and their earnings aren't going to be what they expected. And they're going to say, what's the difference between now and then? Employees working at home and employees not working at home. Yeah, but I think it's super ironic that literally as I'm doing this show that came by. And this morning I was actually listening to some stuff on CNBC, and they were talking about how commercial real estate and office occupancy is down. It's a 17% is the unoccupancy rate. So if you have an office building, only about 83% is rented, and that number has been trending higher. And the value of commercial office space is down between 20 and 30%. But as people come back to the office, those tides might turn.
I would imagine less work is getting done too. I mean, I don't think people probably, if you're at the office, I would imagine you get more done than if you're working remotely, other than maybe, I'm sure there's exceptions to that, but I think in general, most people probably get more accomplished at work. I don't know. I could see it the other way, though, too, because then if you don't have to drive anywhere, there's no commute, probably less just break time as far as like talking with coworkers. Who knows? I don't know if it's a productivity thing or maybe there's not. I have no idea.
Well, it begs the question, how much work really is getting done during the day? Like, how much work are people really doing? Because how do you quantify work? Just hours worked or how much you get done? Like, there's certain jobs that you could say, well, they were able to do X amount in X amount of time, but there's other jobs that it's really hard to quantify directly. Okay, for example, somebody's making phone calls. Easy. You made X amount of phone calls. Talked on the phone X amount of time. Sales. Hard to quantify how hard that person's working.
Well, there is the results.
You have the result, but that doesn't mean it equates to 40 hours of work.
True. Could be less, could be more. Yeah, I don't know.
And you know what? It may actually be kind of the silent way to silently lay people off without saying it. Because a lot of people are like, well, I'm not going to come back to work at the office. So they didn't lay them off. They're just going to have to go somewhere else and work. It also says Amazon's flattening its corporate structure by having fewer managers in each organization. I'm guessing.
I'm not surprised by that.
I'm not surprised with people working at home. They probably were like, well, what's this person doing at home? Like,
well, and it's when things are really, really clicking along, like we're in economic slowdown. So when we're not in economic slowdown, a lot of times bigger companies, the solution is to hire more people. They just start throwing bodies at the different work. But when things are getting tighter, well, you're going to look, how do we become more efficient and get the same done with less? And I'm sure layers of management and, I mean, how many managers of different things can you possibly have?
Part of me
right?
wonders
You probably
if-
start looking at it and you go, well, we got all these different managers and they're working remotely, and I'm sure they're being tracked. Like, whatever technology is provided by a company like Amazon, I'm sure they know exactly how many times you click your mouse and how many words you type and how many emails were exchanged. And if they have a phone tied into their system, and they probably do because they're in the technology business, they probably know how much time you're on the phone and what numbers you're calling. So if you're a manager there and you're just keeping communicating with people and keeping in touch and making sure things are done, that might not mean you're being productive on working towards whatever they want you to work towards.
How much do you think artificial intelligence played into it? They've probably been using AI to say, okay, who's working, who's not, where are the calls going, generate a model for how many managers I need. I guarantee
It would
they
not
use it.
surprise me.
Well, why wouldn't you if the tool's at your discretion? I mean, we know how many phone calls go out or come in and average time. Like, we know that. I can't even imagine what Amazon actually knows. I mean, they know what I'm going to buy before I do, I think.
Well,
Comes up in the recommendations for me. But as we're actually filming this show, Elias, we're actually filming this on the 16th of September, but there's some big things happening, or have already happened. I'll be excited to know what the turnout is, but we're expecting our first rate cut to the federal funds rate since really August of 2019. And the debate that has raged, and by the time we air this, we'll know what the outcome is whether the Fed's going to cut a quarter, a half, and then I read this morning that several lawmakers are actually calling for a 3/4 point rate cut. And I thought it would be good to talk a little bit about what the S&P 500 has done following the first rate cut, regardless of the percentage of the cut, because I think a lot of people see this as positive for the market. The positive thing is it lowers the overall cost to borrow money and should stimulate the economy to some extent. But the converse side is many times after the first rate cut, it actually is kind of the precursor to a recession, if you look back through history. But let's talk a little bit about, Elias, about what the S&P 500 has done following the very first rate cut from the Fed, because once again, if people are thinking they're cutting rates because of recession, the connotation with that is stock market will go down. So why don't we give them the facts, and I'll let you kind of summarize what likely is to happen.
so there's a nice chart here from our research department. So you should be able to see it if you're watching the episode, or maybe find it on our website. But I guess the good news is more than half the time, S&P performance following the first rate cut is positive over different periods. And if you're able to see this chart, there's columns that outline 1 month after the rate cut, 3 months after, 6 months, and 12 months after. So there tends to be positive performance over we'll just talk about a 12-month period, over the next year. Now, that being said, there's always a max drawdown in the 12 months after the first rate cut, which over 12-month periods, 10 to 15% drawdowns are very normal from high to low point in any given 12-month period.
The average is about 13, right? Max drawdown.
Yeah, it's right around there. So I think a couple things. One, if you're really, really concerned about, like, for example, 1 month after the first rate cut, there's been some negative periods, the worst being in 1974, and a month after the market was down 8.5%. Well, the market being down 8.5%, is that any, realistically, is that a reason to abandon what you're doing as a long-term investor? No, it shouldn't be, because that's normal trading activity.
Well, ironically, though, about this, 1974, 6 months after, it was down 20, but 12 months later, it was up 10.
What year are you looking at?
1974. 6 months later, it was down 20%, the market.
Right. So
but 12 months later, it was up 10.3.
Yeah. So so 74 was pretty wild trading year, because 1 month after, market was negative. 3 months after the first rate cut, negative 26. 6 months later, negative 20. And then after 12 months was 10% higher than when the rate cut happened.
One thing I noticed from this chart is the last 3 rate cuts. So that would be 2001, 2007, and 2019. During those periods, it seems like it's been more volatile. If you look at the max drawdown on this chart, the max drawdown in 2001 was 29.7, 2007 was 26.1, 2019 was 33.9. Now, 2 of those 3 years were negative. 1 was positive. 2019 was positive. And I think that just speaks to the general volatility of the market in general. I feel like because of technology, how fast we get information, that the market is just a lot more volatile today, meaning it moves faster. It doesn't take 12 months. If you think back to 1974, I mean, the only way you got your news was opening up and getting the paper, the Wall Street Journal. So it's all a day late, or watching TV. Like, information just didn't travel as fast as it does today.
And well, now if an article comes out and you don't read it until 6 hours later, like, you got the news late.
I just read the Amazon article the instant it hit my screen.
Right. Where, think about, this has happened to me before. Busy working all day, got meetings, doing stuff, and then you get home and something happened in the news that day, and then my wife will ask me, "Hey, did you hear about such and such?" And it sounds like I probably should have, but no, I haven't. I've been busy all day. Well, I'm late. The news only been out 6-7 hours. I'm late to the party.
Well,
it hasn't even been out that long.
Think about, with social media, it's even faster. It's one thing to get like a news article coming through from Bloomberg or CNN or CNBC or something. If you want information really fast, you just go to YouTube or Twitter.
It's all right there.
Do you remember the day the Trump assassination attempt happened, the first one?
Yeah.
When he got shot in the ear. We were at a restaurant. You and I were there together, and Megan's uncle had called a few minutes after it happened. What's the first thing we did? We went to Twitter. Wasn't on Twitter yet. We went to YouTube and turned on YouTube Live. We're like, oh, yeah, that happened. But we had the information
instantly.
Could you imagine if we had to wait till the next day to find out about it?
In 1974, that's what you would have had to know.
I think that's why people don't read newspapers anymore. My father-in-law's like, oh, did you see the news? I'm like, yeah, 24 hours ago. Like, it's old at this point. So I think that just makes markets move faster because people get information faster.
Yeah, and so I could actually see these numbers trending higher both ways, I guess, or maybe a little bit more. When I say higher to the negative, it means lower, right? But I could also see these numbers over time trending higher when they're positive.
Oh, for sure.
Because in the short term, just think how, and it'd be interesting to see, but now it's almost normal to have 1 to 2%. I shouldn't say normal, but it's getting more frequent, 1 to 2% trading days. Or like we had a day last week where middle of the morning, stock market was down almost 1.5%. So I was thinking we were going to close negative for the day. And then the last hour of the day, there's all this buying going on, and the market actually finished, I think, positive. Not very much, but did finish positive for the day. So I think the short-term reactions and the kind of those swings will be probably faster and just more aggressive as we go into the future. But I don't know what that means for these numbers. I could definitely see it being these 12-month numbers when they're positive being more positive, and when they're negative, maybe even being a little more negative than they are historically.
At the end of the day, 66% of the time, the market's positive after the first rate cut with an average return of 5.5%. One thing I want to remind people who are listening to the show or watching, remember, don't get as excited about the actual change in, like, the dollar change in value. I had an individual in my office the other day, and he's like, man, I just don't think the Dow can go to 50,000. That's 9,000 points. And he goes, I remember when it just used to move like, 40 or 50 in a day. I go, yeah, 20 years ago, and it was 6,000 points.
Yeah, it doesn't work.
He just didn't. People have trouble grasping the concept that a 1% move in the Dow Jones, because people still follow the Dow, even though it's probably not the best way to track the stock market. The S&P is likely better, but people still track the Dow. That's 400 points. Like, a lot of people would see 400 points as, wow, that's what's going on. It's not even 1%. 2.5%, 1,000 now. Put that in perspective during COVID, when the stock market went to 20,000 points, 2.5% was 500. We thought that was a big move. Now people are going to see that 1,000-point move and be like, whoa, what's happening? Well, it's just 2.5% now. He literally said, do you see the Dow going to 50,000? I said, at some point.
I mean, in our lifetime, we could see Dow at 90,000.
I mean,
I'm 35. That's absolutely possible.
Possible. It's likely.
Yeah, it's very likely.
So if we just take historical,
could even be much higher. Could
way
even
higher.
Be double that
Think
in my
about it.
lifetime.
Elias.
If I live another 60 years.
No. Rule of 72. What's the average? What's the stock market average? Let's say 9%. Doubles every 8 years. So 44 to 80. In a decade, it could be at 90,000. And then another decade, it could be at 180. Like, these are compounding numbers and it's linear, but the numbers are just going to get bigger and bigger and bigger. Now, that said, what could they do? They could just, do a stock split on it, just so their lower numbers make people feel better. It won't change the percentages, but don't be concerned about pay attention to the dollar move, but more about the percentage move. I think one of the things too that people are so excited about the rate cut that just happened is, one, they think things are going to become more affordable. And one of the things that have been most unaffordable for people over the last 12 to 18 months is housing. In fact, I read a statistic that housing affordability is at the lowest level since 2006. It's actually 55% more expensive to buy versus rent. And if you think about,
what's that number typically?
I don't know what the average is. I just extrapolated that from some stuff I was reading the other day. But if you just think about going into retirement, you have to plan for your housing costs. Like, a lot of homeowners think, well, my house is paid for. I'm in great shape, right? If your house is paid for, you'd think you're in great shape, right? Regardless if you had all kinds of money saved up or not.
I don't know why you wouldn't feel good about that.
So, and a lot of times people who have a paid for home have lived there for a long period of time. They haven't jumped around because, truth be told, people who move every 7 years typically never pay the house off because they're taking a new loan every 7 years for 30 years.
Right.
So a lot of times people have that paid for house, have been there a while. I'm going to throw a scenario at you. You live in South Florida. You have a paid for place. You've been there for 30 years. Your HOA is underfunded, and your HOA fees go to $3,000 a month plus your taxes. What happens?
I might start thinking about moving.
You're going to have to move. It's already happening.
My home's, I'm sure I'm happy with the value of the home, but at some point you're not just going to pay unlimited amounts of money to an HOA or something like that. So I'd probably start thinking about moving somewhere else.
I think the other thing that happens, people that have paid for homes, they get a little overconfident because they go and figure out their net worth. So let's say you got a $500,000 house now paid for. Well, my net worth is $1 million. That's great. But 500,000 of it doesn't count. Like, because you can't live on that $500,000 of home equity. Like
Not for free.
Home equity is almost like this false safety blanket that people have. Because the only way to tap it is to borrow it or sell it. And you're always going to have a housing cost.
It is. And there's record. So Americans have more than $32 trillion in home equity right now. So that's the record. That's an all-time high for how much equity American citizens have into their homes. But like you said, how it's an asset, good to own, yes. How do you access that asset for liquidity? Like, how do you use it? Well, you can borrow money and use it, but you got to pay the money back. You can sell it and use it. And, and if now with that much equity, and this is something I'll speculate on a little bit, as rates come down and people can access the equity in their home through a line of credit or something, I mean, how many people will start looking to do that and then eat up that equity position that they do have?
I think they've already done that.
So even with the record,
I would love to see what home equity balances are. And here's why I believe they probably already done it. TikTok, what do they teach people how to do?
I'm not sure about home equity.
I can't even tell you how many I've watched with like, oh yeah, put this in here, put 20% down and then borrow that equity and buy the next place. And most people, I won't say most, I don't know that for a fact. I'm going to guess a lot of people have a home equity line of credit. And there's another reason why they have it. Mortgage lenders have used it as a way to get around having a 20% down payment. Because to sell that loan, they need 20% down. So what do? Do an 80% loan, sell that to the third party, and then in-house, I'll go to do 15 or 20% line of credit against that house based upon their appraisal. The person essentially put hardly anything down to buy it.
It's also probably the number one funding vehicle for home renovations and remodels.
There you go. And what are people doing now because they can't afford a new house? What do?
Well, they're going to renovate where they live. And if you have a house, like once your house is over 10 years old, it might not be outdated, but it's not like it's
clicking. It's not outdated yet, but it's getting close. I'll give you an example. When we did our house in 2017, we told ourselves we're not going to be there really any more than 8 years. That was the number. Because 8 years is about the time like color schemes change, appliances break down. You start to put all this money into a house that you're just not going to get back out of it.
Yeah, so people do have to be careful with that too. But that's kind of the the equity you have in your home, even if you own it outright, although it counts in your net worth and it counts for like assets that you own. It's just not the most accessible money. Where your investments and your retirement accounts, those are really designed to create your income and your future need for cash. But the home, the home's really not going to do it. And very few people ask this question, or they say, well, I'm planning on downsizing when I retire.
Yeah, they do.
Some people do, not very many. It's like talked about like it's the most one of the most common things for people to do. I think it's actually a very rare thing for people to do.
Elias, they downsize, but they don't downsize the price. They go from the big 2-story where they raise their kids, and now they're aging, so they need to get on one floor. So they sell that place for $500, and they go buy a condo for $500. Like they might downsize the size, but
you're
they
not
don't
going to
downsize the price.
Right, or the quality of the place you have and the lifestyle
Exactly.
you like to live, the type of neighborhood you want to live in. And that's all going to cost the same.
Elias, as we start to look forward to 2025, one of the things that were just released were the new projected tax brackets, standard deductions, and some additional information. And for people who are retired or going into retirement, they should be acutely aware of what these brackets are, because this is your ability to kind of make sure you're taking advantage of your tax bracket. And if you don't know this, or if individuals listening don't know this, taxes are progressive, meaning you pay a percentage on your first set of money, a different percentage on the next set. It's not retroactive to $1. And becomes important for people when they're doing Roth conversions, if they're taking money out for inherited IRAs now that are forced to be out over 10 years. I know I'm meeting with an individual I just did last week, and we're looking at strategies to get money out of an inherited IRA. And we know the Tax Cut and Jobs Act is expiring, and that's going to take the 22% and the 24% bracket to 25%. So we had the discussion, why wouldn't we be maxing out your tax bracket at 24%, knowing they're going up unless the law is repealed or unless the law is renewed, and we're in exactly the same spot that we were before. And just some good numbers here. To stay in the 12% tax bracket, you need $96,500. That is the 12% tax bracket, which that's where a lot of retirees try to stay, is in that bracket. If you go into the 22, that's all the way up to $206,000 as a family. And that's, up quite a bit. I remember that was like $82,000 to be in that 12% bracket. So the good news is cost of things are up. Incomes are up. You're getting a little bit of a reprieve on your actual, tax rate, because you don't jump into that 22% tax bracket quite as soon as before.
So I recently got several questions on this. So I just jotted some down and some notes, and which you touched on in a little bit there. But one of the questions was about how many tax brackets and different rates are there. They not typically, but they range from about 10 to 37% for federal taxes. The brackets, how many, it depends on filing status and a bunch of different things, but there's several. I think one of the key things to educate people on is the progressive nature of tax brackets. And you mentioned it earlier, but you're not paying that percentage on all the money. It's just the money, it goes up. As your income goes up, those brackets go up too. So I think sometimes that's a clarifying thing that people sometimes say, well, I'm in the 24% bracket, so I pay 24%. It's not necessarily true. You'd have to take what you paid, divide it into what you made, and that's going to tell you your rate.
Good example. So the family I'm working with, we're maxing out the 24% tax bracket. We have some great software that actually goes and calculates what your effective rate is. His effective rate is 18.1%. So I said,
Did you know that?
Yeah, did he know in the software? He had no idea. I said,
most people don't. They don't
said,
really
your effective rate's 18.1%. Why don't you just pay 18% on the set of money, like what you're really paying? Obviously, the more money you make, once you get above basically $730,000 of income, your rate just keeps, your effective rate keeps going up and up and up.
Yeah, right, because you're paying the highest rate on more dollars.
Right, like if you make $96,301, you're technically in the 22% tax bracket, but your effective rate is probably like 11%.
Yeah, so the next question was, can we change our tax bracket after we retire? And kind of the short answer is yes, it's possible. It's even possible to do it year to year. Land in a different tax bracket every year. I think a good way to think about it is you can have a little bit more control of your tax bracket and where you fall in retirement, especially if you've done a really good job diversifying the types of accounts you utilize. But at the end of the day, like let's say all of your money's in a traditional IRA or 401k. Well, you can change your tax bracket just by taking money out of that account, because you're going to have to owe ordinary income tax on it. So I think there's a little more, once you retire, there's a little more flexibility into kind of controlling how much income you're going to take. Now, if you have, sometimes we run into where families have good Social Security checks and each have a pension. Well, if that's the situation, there's a certain amount you can't control, right? Because that income's coming in. So that's really going to be your baseline. And then kind of a follow-up on that is, or the follow-up question was, will retirement account withdrawals during pre-retirement affect my tax bracket? And you're going to, if you're working, there's a couple things to think about. If you're working and taking withdrawals from retirement accounts, you're going to pay more in taxes. I don't know if that means you're going to take out enough to pay more in the next bracket up or not, but you're certainly going to realize more taxable income by taking withdrawals out if you're working. And the other thing, you could be subject to a 10% early withdrawal penalty if you take withdrawals before 59 and a half.
Well, I think the thing to think about there is you should have a distribution strategy, not just about like cash, stocks, and bonds, but also that surrounds or takes into account some level of tax planning. I think the goal for taxes is to pay what we owe, but at the same time, minimize our tax liability as long as we're doing it legally and ethically. Which is just sometimes deciding, am I going to take it from account A or account B based upon its tax status? So there's just more ways to diversify other than just stocks and bonds. That's a lot of the stuff that we do when we start to put together really personalized financial plans for people. With that said, if anybody's looking to get help with that personalized financial plan, you can click the link into the description, or you can go to btwellshow.com. I want to thank everybody for listening and hope you keep tuning in.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.